Nigeria's regional trade influence is gaining new momentum as recent policy reforms begin to reshape the country's standing across the continent. With improved trade frameworks, better cross-border coordination, and rising investor interest, Nigeria is positioning itself to play a stronger role in Africa's economic integration. Hello, welcome to MarketSquare, your go-to show for deep insights into business and economic trends. I'm Olaitan Adebayo, and today we're breaking down key developments across Nigeria. Stay with us. Welcome back to MarketSquare. Nigerians pushing hard to talk about the African Continental trade area into something traders and manufacturers actually feel at the border. At a summit in Abuja this week, the government framed its reforms, exchange rate unification, fuel subsidy removal, port modernization, and digital customs not as abstract policy wins, but as practical steps to shrink clearance times, cut costs, and make intra-African trade routine rather than exceptional. The president's message was simple: borders should open up opportunities, not shut them out. That rhetoric is being backed by a squeeze on paperwork and a push for technology. The national single window, which the presidency says will begin phased operation in March 2026 with full rollout by December 2026, is meant to let importers and exporters submit cargo data once and have agencies talk to one another electronically, a change that could cut average clearance times from around 3 weeks to under 7 days, if it works as promised. If Nigeria delivers that, the savings in demurrage, warehousing, and time to market would be immediate and measurable for businesses. Cargo clearance times at major seaports are falling sharply since 2023, and governments and customs authorities now speak openly of shifting targets from weeks to days. Those are the kind of operational improvements that matter to manufacturers who live off predictable supply chains and to traders who lose margins every day a container sits idle at the quays. But turning pilot projects and targeting to nationwide reality across dozens of ports and customs posts is the hardest part. The trade push is not only about speed at the ports. Officials are also trying to turn improved customs performance into export growth. Non-oil exports have been rising, helped by higher global demand for a few commodities and by export promotion efforts, and the government is keen to redirect that momentum into African markets rather than just sell abroad. If customs can enforce rules of origin reliably, apply professional tariffs, and cut red tapes, African buyers will find Nigerian products easier and cheaper to move across borders, a direct test of whether African Continental Free Trade Area moves from agreement on paper to orders on trucks. But the economic sphere requires realism. Faster clearance and digital windows reduce costs and uncertainty, and they can raise trade volumes. They do not by themselves fix supply side problems that make Nigerian goods uncompetitive. Manufacturers still struggle with higher energy costs, logistics bottlenecks, and imported input prices. Clearing a container in 3 days instead of 21 helps it, but if the factory that fuels that container can't run reliably because of power outage or expensive diesel, the net gain will be limited. The reforms must therefore be part of a broader sustained push to lower production costs, not just a one-off customer miracle. There is also a revenue angle. Modernized customs and a functioning single window make it easier to track trade, reduce leakages, and improve collections, which matters for fiscal policy at a time when the government across the region are hunting revenues to fund infrastructure. But the short-term politics are sensitive. Progressive suspension of duties on the African Continental Free Trade Area and any reduction in border friction will require mechanisms such as African Continental Free Trade Area Adjustment Fund to compensate the revenue shortfalls for countries that depend heavily on tariffs. Past integration efforts across West Africa stalled not because the idea was bad, but because member states failed to implement commitments consistently. For Nigeria, the test is whether the reforms move beyond symbolic targets into day-to-day practice. Custom officers using risk-based inspection, ports clearing cargo in days rather than weeks, traders invoicing in local currency where possible, and export corridors operating without arbitrary hold-ups. Success will be judged by trucks on the road and invoices paid on time, not by summit communiques. There is genuine upside if the implementation holds. Faster clearance and lower trade costs would make Nigerian goods more price competitive across Africa, encourage regional value chains where input travel short distances and final goods are assembled locally, and reduce dependence on distant markets for both inputs and customers. For a continent that needs most industrial scale, predictable customs and interoperable digital system are the plumbing that makes factories viable. If Nigeria can make its single window the standard and export that know how, the country can capture first mover advantages in regional logistics and services. The CPAT summit and the policy package that came with it are a clearer attempt to move from promise to performance. The elements are in place. Political will be at the top, institutional realignment across customs and ports, backing from continental banks and global custom bodies. But the outcome will depend on consistent execution, cross-agency discipline, and measures that lower production costs at the factory gate. If those follow through, traders and manufacturers will see real change at the gate. If not, the reform will remain an encouraging speech rather than a daily reality. While reforms are strengthening Nigerian standing in continental trade, another signal of progress is emerging. Foreign exchange inflows are picking up as investor confidence returns. There is a shift happening in Nigeria's foreign exchange markets, and the numbers are beginning to tell the story. For the first time in months, inflows are picking up in a way that shows investors are slowly reassessing their view of the economy. October alone saw $5.15 billion flow into the FX market, up from $3.18 billion in September. A 62% jump doesn't happen by chance. It ties to one thing: everyone in the market now acknowledge the CBN's reform have changed behavior. Since Olayemi Cardozo took over in 2023, the central bank has been trying to clean up, clearing the FX backlog, unifying windows, any opaque intervention tactics that scared investors for years. For an economy that has battled liquidity shortages and reparation delays, the recent improvement shows that credibility is starting to return. Even foreign portfolio managers who left the markets are beginning to say what many have been hoping to hear: Nigeria looks like it's back in business. But beneath the optimism, the real picture becomes clearer when you examine where the money is coming from. Most of the inflows showing up in the data are still hot money, fast, sensitive, portfolio-driven. The MBS numbers place capital importation at $5.64 billion in Q1 2025, a 67% jump year-on-year, yet more than 92% of that is short-term portfolio investment. Only a tiny fraction, barely above 2%, is actually FDI, and that is the concern. Portfolio money behaves like a visitor. It comes for the yields, but leaves at the slightest discomfort. Investors are piling into treasury bills, open market operation instruments, and bonds because the returns are simply irresistible, with yields hovering between 18 and 25%. But when it comes to long-term bets, factories, infrastructure, deep capital, they are still holding back. Issues like power instability, insecurity, and rising input costs are hard for any investor to ignore. The recent Eurobond story adds another layer. Nigeria raised $2.25 billion, and the appetite was strong enough to oversubscribe the issuance at a rate around 8.6% and 9.1%. It signals something important. Global investors are willing to hold Nigerian risks again as long as policy direction stays consistent. But even with that success, the same pattern shows up. Investors are comfortable with exposures that allows them exit quickly. The banking sector is emerging as the biggest beneficiary of this liquidity wave. More than half of all the imported capital in Q1 went straight to the banks, lining up with the recapitalization push. With the country eyeing $1 trillion economy, banks are under pressure to strengthen their buffers. What is interesting is that local investors are taking charge of many of these capital raises, showing that confidence is not only coming from abroad, it's building from within. When you look up closely at why inflows are improving, everything points to timing and reforms aligning. The FX market is functioning more predictably, the Naira isn't swinging widely, global rates are easing, and the Nigerian offers some of the most attractive yields in the emerging market space. The CBN is also keeping its hand off the rates it once tried to defend at all costs. The absence of strong FDI signals that investor does not yet trust the operating environment enough to make decade-long-term investments. Infrastructure challenges, insecurity, and rising production costs continue to drag on sentiment. These are problems portfolio money cannot fix. Cardozo's recent comments tie everything together. At the IMF World Bank meeting and again at the CBN executive seminar, his message was direct. If the fundamentals are right, investors come naturally, no need for persuasion. He wants banks to act like true market makers, not spectators waiting for the CBN to set the tone. With stronger reserves, easing inflation, and a calmer FX market, the central bank is now pushing banks to take more responsibility in shaping liquidity. The inflows are real, but they are mostly short-term and can disappear as quickly as they arrive. Turning this moment into something lasting requires more than attractive yields. It requires a system that investors can trust, a stable policy environment, and a structural reforms that reduce the cost and the risks of doing business. Beyond market performance, transparency is also getting a boost with the World Bank launching a blockchain-based funds chain to track public projects. A new era in financial management is unfolding in Nigeria, with blockchain technology taking charge to tighten oversight of donor-funded projects. At a workshop in Abuja this week, Dr. Shamsidin Ogujimi, the Accountant General of the Federation, unveiled the World Bank's fund chain system, a platform designed to make the movement of development funds transparent, traceable, and accountable. Funds chain creates a tamper-proof digital record of every transaction, allowing all authorized stakeholders from project accountants to auditors to track how money moves from disbursement to final payment. 6 World Bank-backed projects will be included in the initial phase, giving the system a test run before a broader rollout. The goal is to reduce financial leakages, prevent undocumented advances, and ensure funds reach their intended targets. The reforms go beyond technology. The Office of the Accountant General has developed the Financial Management Manual to guide all transactions under World Bank-supported projects, making compliance mandatory for project coordinators, accountants, and financial management units. This move is paired with a policy preventing the removal of project finance staff within 6 months of project closure, ensuring continuity and minimizing risks of lapses in reporting or implementation. The early results are already tangible. According to the AGF, collaboration with the World Bank has reduced lapses loans from $18 million to $7 million, a 61% drop, and lowered undocumented advances by 15%. These numbers suggest that even small procedural investments, where enforced regularly, can yield measurable gains in project efficiency. The timing of this reform is significant. According to data from the Debt Management Office, the World Bank remains Nigeria's largest multilateral creditor, holding $19.13 billion of the country's $46.98 billion external debt. Strengthening financial management in donor-funded projects not only protects these resources, but also demonstrates institutional discipline that could attract further international support. The system blockchain architecture ensures that every transaction is traceable, reducing the opportunity for diversion of funds and improving confidence in reporting. For project managers and accountants, it brings greater predictability in audit and financial reviews, while for policymakers, it offers reliable data to guide decisions on scaling and funding priorities. Over time, the hope is that better transparency will attract more donor inflows, encourage responsible project execution, and reduce the need for heavy oversight from external partners. Adoption of the system across all projects require capacity building, sustained monitoring, and cultural change within public institutions that have historically relied on manual or paper-based systems. Ensuring that staff follow the new processes and that the manual is consistent applied will be key to translating this technological upgrade into real impact on the ground. The rollout of fund chain is a reminder that reforms in financial management are not just about rules on paper. They're about creating systems that enforce accountability, reduce wastage, and ensure that resources meant for development actually reach their targets. And on the consumer side, Nigerians can expect some financial relief soon, as 5 common bank charges are set to disappear from January 2026. The coming year is shaping up to deliver one of the most noticeable shifts in how Nigerians interact with their banks. By January 2026, a set of charges that have followed basic banking transactions for years will disappear following the tax reforms laws signed by President Bola Ahmed Tinubu in June 2025. And unlike many policy announcements that feel distant from everyday life, this one hits where Nigerians feel it the most. Digital payments, salaries, investments, and routine transfers. The biggest signals come from the removal of 50 naira electronic money transfer levy on transfers above 10,000 naira. For a country where electronic payments dominates daily transactions, this levy has been a persistent irritant. Millions of small transfers from food vendors to ride payments have carried extra charge, and the decision to scrap it aligns directly with the government promise to ease the cost of doing business and expand financial inclusion. Policymakers have long argued that digital adoption depends on lowering barriers, and this step finally reflects that logic. Salary earners are also set for a direct boost. Stamp duties that accompany monthly salary transfers will no longer apply. Workers keep more of their pay, and the business, especially SMEs, already stressed by higher operating costs, no longer pay administrative fees tied to payroll processing. It's a quiet but practical relief. The investment side of the economy is also receiving attention. Stamp duties on transactions involving treasury bills, government bonds, and shares are being abolished. For investors, this trims transaction costs for the capital market. It widens the door for new participants who previously viewed these extra charges as unnecessary friction. Even documentation duties tied to stock or share transfer will be removed, simplifying paperwork for brokers and investors who have long complained about the cost and bureaucracy of Even documentation duties tied to stock or share transfer will be removed, simplifying paperwork for brokers and investors who have long complained about the cost and bureaucracy of capital market process. Many Nigerians manage multiple accounts for budgeting, savings, or business transactions, and these fees often serve no logical economic purpose but beyond revenue collection. Its removal improves cash flow management for individuals and small businesses that move funds frequently. According to Taiwo Idele, who heads the Presidential Committee on Fiscal Policy and Tax Reforms, all these changes stems from new provision in the Nigerian Tax Act 2025. The Act introduced explicit exemptions that override earlier rules under the Stamp Duties Act and Finance Act 2020. In his explanation, the goal is straightforward: simplify tax administration, eliminate unnecessary burdens, and create a system that supports rather than penalize everyday economic activity. What this means in practical terms is that reform is not just a cleanup of old tax. It's a recalibration of how the government views small transactions no longer as a revenue target, but an engine of economic participation. And that's where we wrap up today's episode. From Nigeria's renewed push to strengthen its continental trade presence to the steady rise in foreign exchange inflows, the World Bank rollout of a blockchain-driven transparency system, and the relief coming from Nigerians as multiple bank charges get eliminated. I'm Olaiton Adebayo, and this is Market Square. Thank you for watching, and see you on the next one.